Hi, my name is Viviana and Mathew with the metric number 86009. Today I'm going to discuss about compare and contrast the valuation methods. The 5 valuation methods that we have chosen are asset-based valuation, market value valuation, discounted cash flow valuation, book value valuation, and return on investment valuation. Today I am going to discuss about the focus of each valuation. So as for market valuation, it focuses on market sentiment and comparable data. As for asset-based valuation, it focuses on underlying asset value. Next, the discounted cash flow valuation focuses on future cash flow projections. Other than that, the book value valuation focuses on historical accounting data, and lastly, return on investment ROI valuation focus on investment probability.
Hello, I'm Jacqualine Kah Shu Xiang with metric number 84088. And now we're going to see from the perspective of ease of use among these 5 valuation methods. So, among all of these 5 valuation methods, market value valuation is the most easiest one compared to the 4 other valuation methods that left. Followed up by book value valuation and return on investment, which is still easy but not as easy as market value valuation. Followed up by asset-based valuation. We can see that it is moderately complex compared to the 3 other valuation methods. And the last one, discounted cash flow. It is the most complex one among all of these 5 valuation methods.
My name is Stephaney Anak Peter with metric number 82963. So I will be comparing the data availability of each valuation that we have researched. So for the first valuation, we have market-based valuation, where it has all the data readily available. Next, for the asset-based valuation, it requires detailed asset valuation. Meanwhile, for the discounted cash flow valuation, it requires future cash flow projection. Apart from that, for the book value valuation, it relies on the company financials. And lastly, for the return on investment valuation, it requires the investment cost and return data.
So here's a quick overview of accuracy based on each method. So for the first one is market value valuation. It reflects current market condition but may miss company specific details. The next one is asset-based valuation. It is accurately values tangible asset but often undervalue the intangible assets and growth potential. For the DCF valuation, it is very highly accurate for companies with predictable cash flows, even though it is very sensitive to assumptions. Next, book value valuation. It is based on recorded asset value. That's why it may not reflect the true current value of those assets. Finally, ROI valuation is a straightforward measure of profitability, but it can ignore other important valuation factors.
Hi, I'm Nithiyasari Saravanan and my metric number is 84868. So, I would like to continue the discussion by explaining the suitability for the methods we select. Firstly, for the market value valuation, it is publicly traded companies and mergers and acquisition M&A transactions. Then, for the asset-based valuation method, it is capital-intensive firms and bankruptcy situations. For the discounted cash flow valuation method, companies with stable cash flow and strategic planning. Besides that, for the book value valuation method, they are major companies with stable assets. Lastly, for the return on investment ROI valuation method, it is evaluating investment performance.
Through the discussion, we can assume that the best from valuation method is market value valuation. It is because of its simplicity. Since its valuation based on the market price of similar assets also tend to be more reflective of current market conditions. Besides, market valuation is highly relevant because it corresponds to the latest market trend like industry trend, competitive landscape, and macroeconomic condition. Readily available data also make one of the reasons why it's best valuation method. This method relies on readily accessible data because it utilizes information from publicly traded corporation or recent transaction in the market. Since it's very transparent, it's widely accepted by many firms because its versatility and easy to use. The market valuation approach has established it as industry standard. To conclude, market value valuation is the best valuation method compared to other valuation methods. The main reason because of its transparency by disclosing the financial data publicly, making comparison easy for the stakeholder and the investor. The firm valuation method considered important because it's strategic planning for long term, employee motivation, diversity of their service and product, revenue gaining, operational efficiency, and tax benefits. In considering the best valuation method, those aspects must be considered.